Okay, everybody, it's me. Yep, it's me and you. And I just happen to be Gregory Mannarino. And you are lovely, all of you. All right, people, look, let's talk. Did I say the date? Monday, September 27, 2021. It's back to work. And so let's do that. What's going on? Before I start talking about economic news and the market, I want to clarify something maybe to make things easier for all of us. Now, if you've been following this blog over the past week, I explained to you that there is a market indicator, a risk indicator that I came up with recently. I was initially calling this the X factor. I couldn't think of a good name for it, but I want to change the name and I want to give you a range to pay attention to. And in fact, what I'm going to do is put this whole thing in the description of this video so you can pay attention to it and you could gauge this for yourself. I'm going to start incorporating this little equation and number into my market reports every day so we can gauge market risk. So let's clarify this. Right now, I'm going to call this the Mannarino Market Risk Indicator. Mannarino Market Risk Indicator. And we achieve this number very, very simply. We take the Dixie or the dollar index, we multiply that times the 10-year yield, and we divide that by 1.6. It gives us a number. Today that number sits at about 86. Now the range that we need to pay attention to is between 50, meaning very, very low risk, and 400, high risk, okay? That's the range here. It is possible to go outside of this range, but this is what we are going to focus on, between 50 and 400. And again, like I just said, this number sits at about 86 today. Now, let's go to the market. Right now, that 10-year yield continues to get attention here from the mainstream media outlets, even this morning here on Bloomberg. Okay, beautiful, just lovely. It's about time people pay attention to this stuff. I don't know, it's always some other crap they're trying to get you to focus on, but now they want you to look at something real. This is not a surprise to you. Again, I explained recently in a Markets A Look Ahead 2 weeks ago that we might see something like we're seeing now, that 10-year yield pushing the edge of the envelope to the high end of the range that we have been stuck in for a long time with regard to that 10-year yield. This is on speculation that the Fed is in fact going to raise rates or something at one particular time. We're going to talk more about that in a minute here. Now, again, I don't want you to fixate on that number itself. What we are going to do from now on, okay, is look at the Mannarino Market Risk Indicator. Okay, that's what we're going to do henceforth. Okay, it's just lovely. You know how it works. I just covered this at the beginning of the video, and I will put this in the description of this video. So, what does this number tell us today? Well, very low risk. Well, low risk. All right, very low would be like 50. So we're at a low risk threshold, and that means we should be buying the dips here, people moving forward in this market. And again, look, I will keep you on top of this every day. There's no guesswork. I'm going to take it all out for you. I'm going to outline things in a way that's very simple so we can all make this shit show work for us, because that's what this is here, and I think you all know that. So again, like I said, low risk number according to the Mannarino Market Indicator. Let's look over at the stock market right now. Trading doesn't start for about 25 minutes. Stock futures are kind of mixed. You got, at least now, it may change. Dow futures higher, S&P futures lower, NASDAQ futures lower. Crude oil getting bid up yet again. nearing $76 a barrel. It's going much higher. Much higher, people. Forget about Jim Cramer's top. It was not a top. I know a lot of you got all giddy over that. No, I'm sorry to inform you that it was not a top. We're going higher. We will surpass that number relatively soon. Okay, with that said here, let's move forward. So we got some economic news today. Now apparently the durable goods orders today came in better than expected. However, debts and deficits continue to balloon, hyperballoon. So this number is nonsensical in my view, and it's probably not even real. Now we also found out this, and you might want to sit down. This is epic. So Fed President Evans came out. This is one of those things, people, you can't make up. If you tried to, you couldn't do it. So Fed President Evans is saying he is worried, I'm reading this, that the Federal Reserve is not creating enough inflation. It's not high enough. Got to go higher. Again, so what is he saying? He's saying the Fed is going to continue to inflate. Meanwhile, he also said that the Fed is very close to meeting its taper threshold. Now remember, like I said yesterday, taper, good. They can taper all they want to. It doesn't mean they're stopping buying assets. They will still be purchasing epic amount of assets like you can't even believe. And I don't think they're going to taper at all. I believe that through some backdoor mechanism, the Fed will be increasing asset purchases because that's their goal, to buy it all, to be the lender and buyer of last resort, period, the freaking end. Okay. Let us move forward here, people. So right now, gold is flat, slightly higher. You got silver catching a bid. You got cryptocurrencies that are flat. Again, look, with crypto, they just took a pretty big hit over this whole thing with China making it illegal. In my view, again, this is a buying opportunity with regard to cryptos. It's not going to make a difference in the long run. It's not going to. So just don't worry about it. Again, you know my take on all this. Being invested in a non-central bank issued mode of transaction or way to transact is the way to go. You want to be in a central bank issued note, good for you. Good for you. That's all I have to say. You need to be in gold, more importantly, silver, and in my view, crypto. I'm not saying go in on this, people, and the space isn't for everyone, but some crypto needs to be in your portfolio as a long-term hold. The debt's not going to stop ballooning, okay? Debts and deficits are not going to stop. So you need to be on the opposite side of this. I don't know another way to put it. I really don't. And being that the game remains risk on, again, just looking at the Mannarino market risk indicator, okay, if you want to look at anything else, go ahead. But this is the one I'm going to be focusing on. It's risk on. Risk on remains. And it will remain this way until it changes. And now we have something to literally look at and gauge every day. It's very simple to figure out. Again, check the description of this video, and you can do it every day. I'm going to talk about it every day, but this is a way you can do it on your own as well. All right, people. So that's really just set up this morning. Kind of a mixed open for the market. Our risk indicator sitting at about 86. Okay, nothing major going on. Crude oil catching a bid here. It's very, very nice, at least from a market standpoint. That's it. We got this covered, you and me. We're going to continue to cover this. It's not going to stop. We're invincible in my view. In my view, nothing can stop us in this environment. We know exactly what's going on. We know how to capitalize on it as well. You understand? Look, we got to take care of ourselves. We got to take care of each other. We got to embrace what I leave you off with every Friday, which is love each other, care about each other, be charitable. We can make a difference in the world. All of us can. And not just by keeping ourselves on the right side of this entire thing, which we have been for a long time, but embracing the fact that again, and I really believe this, that we are all responsible for each other. And we can change the world. We can change the world. We can if we just, spread a little love around. It's not that hard to do. All right, look, that's it, people. I'm out of here. I will see all of you at the end of the day. Again, check the description of this video for the market risk indicator we are going to follow from today moving forward. All right, I got you covered. I got your back, and I will never let you down. I promise you that. See you later.